You are watching Asia Fest, and let's take a look at how Chinese markets are shaping up after its worst start to a year since 2016. Chinese stocks ended sharply down yesterday to the lowest level in more than 2 months on data showing a slowing economy and ahead of potentially higher tariffs. Today, we're looking at a mixed picture at the start of the trading day. The Shanghai Composite about flat, Shenzhen Component down some 0.3. Hang Seng climbing higher by also 0.3%. A look at the yuan as well, how it's faring this hour, 7.299 there. The Chinese yuan kicked off the new year at a 14-month low yesterday after 3 straight years of losses. China's State Council is scheduled to hold a press conference in the next hour on the economy. And Francis Tan, Chief Strategist, Asia Indus Wealth Management, joins us for more in our studio. Francis, thanks for coming in. Of course, Asian markets, earlier we looked at South Korea, Australia as well, Singapore, kind of breaking ranks there with the US counterparts to move higher this morning. Is this going to be reflective of what we could see in the markets this year?
Interestingly, this year has been a year very much talked about because of what's going to happen on the 20th of January with Trump is going to be the president for the next 4 years, right? And much also talked about is the type of effects that if the tariffs do come in, and especially at the 60% mark, what kind of new dynamics that will shift into this part of the world, Asia. Now, if you look at the IMF's latest forecast, by 2030, China will be the number 2 world economy. Next up will be India, number 3. And if ASEAN is one whole country by itself, ASEAN is going to be number 4. So other than the rank number 1, US, the next 3 countries or regions will be in Asia. But is this going to move us away from IMF's forecast because Trump's going to be the president for the next 4 years? I don't think so. Because at the end of the day, we have seen how Trump was the president earlier in 2017 to 2020, and how China and in fact the rest of Asia have been shifting quite aggressively to move their production out of China. Well, much has been said also about tariffs being levied on things that are made in China. Now, guess what? A lot of people think that the round tripping of the goods, maybe having a production base in ASEAN, you may escape tariff. The next wave of tariff could be goods made by China. But luckily, interestingly, I don't think the tariff will be affecting goods made because of China. So now I think a lot of analysts are also a bit more worried about the goods made by China, meaning Chinese firms in the rest of the other countries, particularly in ASEAN, and how that will affect our economies and markets over here. For now, it's sort of like a known unknown. It's quite a big question mark, and I don't think it will happen that quickly, at least in 2025.
Right. Okay. So that's a lot of questions on that front. One thing was that 2024 last year was supposed to be a strong year for stocks, and we did see kind of that, yes. But things sort of faltered towards the end of the year, and we're kind of seeing this sentiment like spill over into the start of this year as well, especially for US stocks, as we've been tracking this morning. Talk to us about your optimism for this region, because you say that the place to be is in Asia. Talk to us about your optimism for this region, especially you talked about these unknowns.
Okay, so 2024 started off as a big question mark for US equities, because at the end of the day, no one really knows whether the Fed was going to cut rates or not. So the market at the start of 2024 were expecting 7 to 8 rate cuts, hoping that could influence the Fed a little bit. But at the end of the day, we stick to our 4 rate cut scenario, which in the end, actually we did sit there. However, right now, the market seems to be a little bit jittery on the US front, mainly because valuations are currently a little bit higher, in fact, above the 1 standard deviation in terms of the S&P 500. And at this point in time, the futures market is thinking that the Fed may not cut rate as fast in 2025. Now, because of that, there's going to be a push factor by fund managers around the world, thinking that on one hand, US a bit too high in terms of valuation. Secondly, the Fed may not cut rates as much. Where are we going to park our money? Are we going to take profits? Which I do think there's going to be some profit taking. It could be as fast as within the next 2 months. And when you take profit, you're not going to leave it in deposit, not going to leave it in cash, because we still think that deposit rate will continue to go down. So that means that the next big place is Asia, because European growth, European dynamics is still on the slow side, and that really leaves investors or fund managers with no choice but to look at Asia. So on one hand, push factors into Asia. On the second hand, I would think that the stimulus measure in China will be providing a more positive externality for the rest of Asia.
And speaking of that, okay, so the Chinese equities were the worst performance in yesterday's session. Signs of slowing economy continue to show themselves, and also because, basically they're bracing for, Trump's tariffs, whatever they may be. Right. But now we're seeing this report by the Financial Times saying that the PBOC plans to cut rates at, quote, an appropriate time this year. So what do you make of this potential move by the PBOC, when it could happen, and whether rate reform could feature heavily this year?
Okay. So we saw last year, 2024, S&P 500 ended the whole year with 23% up. But guess what? Chinese equities end the year 19% up. Although for the most part of 2024, it was down, as very much as for the past 2 to 3 years, but it was due to the stimulus that's committed by the Chinese policymakers on both the physical and monetary side that boosted equities. So now guess what? This year, we are going to see more rate cuts coming up, and that's from a monetary front. And from a physical front, we're going to see more stimulus coming in terms of making sure that the housing market do not go down any further. A lot of Chinese wealth is locked in the housing market. And when it's locked in, and if you think prices are going to still be stagnated, it's going to ruin your confidence. So that will be the first key thing to ensure housing market is okay, confidence goes up, more aggregate demand is going to be pushed up. So I think this year will be a better year for Chinese equities, as can be seen as an extrapolation of what we saw over the last 3 months of 2024.
And finally, before we go, talk to me about your focus this year and some investment strategies that you think people out there should really be paying attention to.
Okay, so it's always easy to extrapolate the 23% growth in the S&P 500. I mean, the US is still the deepest and the most liquid market in the world. In terms of a long-term strategy allocation, US should still be a big part of any investor's portfolio. However, year to year, there can be gyration, and tactically, we think that is a little bit too overvalued right now for us to add more positions. Now could be some time to pair off a little bit of the profits that you have set over the last 1 year and to move them into some of the very undervalued sectors, and that could be really centered in China, centered in Asia this time around. So I believe I will see quite a bit of a shift in terms of fund flows. There will also be a shift out of money market and cash into risk assets like fixed income, which is bonds or equities this year, because the rates for money markets, the rates for cash is going to drop further. So such things as fixed income will be one of the key things that I believe investors should start to look at if they have not for 2025.
All right, Francis, really appreciate your time, your insights, and what we can look ahead for this year. Francis Tan there, he is Chief Strategist Asia, Indus Wealth Management.